one of the widest competitive moats I've ever analyzed belongs to a company most retail investors have never heard of. Its software sits inside the design process of essentially every advanced chip being built right now. Every AI chip, every GPU, and every processor. With gross margins of nearly 80%, 40% revenue CAGR for over a decade, and a backlog of over 1 year of revenue. And I'm still not buying it. Yet. The company is Synopsys, and by the end of this video you will know exactly why the moat is close to unbreakable, and the price, the stock becomes a buy. So if you ask the average retail investor to name the main players of the AI boom, you will get the same list of hardware players every time. Nvidia, TSMC, Micron, and the hyperscalers. But there is an invisible software player behind those hardware providers that makes the entire semiconductor supply chain possible in the first place. Because before TSMC can manufacture a chip, someone has to design it first. And chip design doesn't happen in a notebook. It runs on software. Specialized and expensive software that only a handful of companies on Earth can build. And Synopsys is one of them. They operate across two segments. The first, and by far the larger one, is design automation. This covers the electronic design tools. These tools take a chip from a circuit concept to something a foundry can actually manufacture. Think of it as an architectural software for silicon, except the tolerances are measured in nanometers, and one mistake can cost a chip company 12 months and tens of millions of dollars when the tape-out fails. Also inside this segment is everything Synopsys acquired from Ansys last year. That's thermal modeling, structural analysis, and electromagnetic simulation. Basically the physics layer that determines whether a chip holds up in a real system, not just in a design environment. That all sits under the design automation now. The second segment is design IP. These are finished and pre-designed building blocks like interface controllers or memory subsystems that chip companies licensed instead of building from scratch. This saves them a lot of engineering time and creates a second layer of lock-in on top of the design tools for Synopsys. But here's the thing. The majority of retail investors are not aware of Synopsys. Why? Because Synopsys doesn't make a consumer product. They don't have a flashy consumer brand, but their software is still essential for the engineering workflows of companies like Apple, AMD, and Nvidia. In most software markets, there are a dozen meaningful competitors. In EDA, the software that designs chips, you effectively have two: Synopsys and Cadence. Synopsys and Cadence together control roughly 62% of the market. Add in Siemens, the third biggest player here, and 3 companies own nearly 3/4 of the entire industry. That's not a competitive market. We essentially have a duopoly with a niche player on the side. But a big market share alone doesn't make a moat. And what makes this one so durable is what happens when a chip company tries to leave. Because a chip design cycle runs 3 or 5 years. During that time, engineering teams build millions of lines of custom scripts on top of Synopsys APIs. Scripts for verification flows, timing analysis, and power optimization. And those don't transfer to another software. They are built for a Synopsys toolchain. So switching the EDA vendor isn't just a migration. It would mean starting over. And that's before you factor in years of engineer training for this specific platform. And the numbers reflect it. Roughly 75 to 80% of Synopsys revenue is recurring revenue, and the backlog stands at 11 billion. That is pretty high, especially when we consider that the revenue last year was just around 7 billion. So that's a backlog worth more than 1.5 years of revenue. And on larger accounts, those spending over $500,000 a year, the net revenue retention is above 100%. That means that these customers aren't just staying. They are even spending more money with the company every year. And a large part of why these customers stay is the foundry layer. This is the one that makes the moat almost impossible to replicate. Because when TSMC or Samsung develops a new process node like 2 nanometer for example, Synopsys engineers are embedded on-site at the foundry for up to 3 years before the node ever launches commercially. They co-develop the process design kit, the PDK, with the foundry, and they work with all major foundries. This provides the technical foundation that every chip designer needs to build on that node. So by the time the production node is ready, Synopsys tools are already certified and deeply integrated into the foundry's workflow, which smaller competitors don't even have access for. And with ANSYS now being fully integrated into the design automation segment, the Moat also extends up the value chain, from semiconductor design into the physics and packaging problems. As chips get more complex with more chiplets, smaller nodes and higher heat density, those problems become critical to whether a design actually works in a real product or not. And the clearest proof of what this mode actually means doesn't come from the financial statements. It comes from China. Because after US export controls tightened in 2025, Chinese chip makers lost access to certified Western EDAs. Domestic alternatives stepped in, but the results showed the power of the Western systems. Because China's first-time tape-out success rate dropped from 24% to just 14%. That means that only 1 design in 7 worked, the other 6 failed. And that means that millions of dollars and months of work were wasted on faulty chip designs. So for chip designers, Synopsys or Cadence software isn't even optional, it's mandatory. And that's the mode. And the numbers also confirm it. Over the past decade, Synopsys compounded their revenue at roughly 40% per year. And as the graph shows, this is consistent compounding across different semiconductor cycles, across industry downturns, and across multiple generations of chip designs. Their gross margins have historically been above 70%, with operating margins coming in at around 13%, down from over 20% because of the ANSYS acquisition. It still shows the margins of a company where the core product is software with high fixed cost to build, but near zero costs to deliver. Before the ANSYS deal, the ROIC was also touching 20%. That's a business earning well above its cost of capital on every dollar reinvested. Not because it got lucky in a cycle, but because of the high moat and recurring contracts. But the last number dropped significantly after July 2025. We'll get to why in a second. But before we go there, if you like this kind of objective analysis and think that it helps your own investing, hit subscribe. I post up to 2 of these videos every single week. Now, to see how this combination of structural dominance and high financial returns translates into an objective score, we can look at my quant rating tool. Overall, Synopsys gets a mediocre score of 5.3 and 5.5. Their quality subscore is very strong with the best mode rating and a strong secure year trend. The growth score also reflects what I just showed you. A strong growth over the last years and a pretty good outlook for the next ones. Only the EPS growth is noticeably lower. The reason for this is that the company issued a lot of shares for the ANSYS acquisition, which in turn lowered the earnings per share. So even though this doesn't look nice, it was a one-time effect. But look at the net debt and interest coverage graphs. We have a net debt to EBITDA of 3.2 with an interest coverage ratio of only 2.7 times. So the balance sheet is where the real issues are. But we need to put these values into context. Because the ANSYS deal closed in July 2025. And when we look at their free cash flow, for example, it was 1.27 billion in 2024, 1.35 billion in 2025, but the guidance for 2026 is over 2 billion. That's over a 50% jump in just a single year. About 80% of the jump is the ANSYS consolidation. The first full year, the combined cash flow is paying off. But Synopsys paid $35 billion for these cash flows, so they weren't earned organically. When we strip out the acquisition effect, the underlying growth is mid-teens. And these effects also distort the forward-looking growth metrics. Before the deal, Synopsys also carried net cash. Today, roughly 8.3 billion in net debt. But this is already down from over 12 billion at the deal close, not even 1 year earlier. So they have already paid off nearly $3 billion. This is deliberate acquisition financing with a fast deleveraging. But it is still a fundamentally different balance sheet to what the historical records show. And that brings us back to the return on invested capital that is also down since the acquisition. The reason for this is the goodwill of the acquisition that inflated the invested capital base. When this invested capital gets inflated, it changes the ROIC math instantly. The operating profits also change, but this change takes some time to scale. Now, that doesn't mean that the ROIC will jump straight back to the 20%, but I would expect that it will climb up steadily again when synergies between both businesses are unlocked and the one-time effects of the acquisition fade. Now, the interest coverage of 2.7 times looks still pretty worrying. But this is the GAAP number. On a non-GAAP basis, this is closer to 8 times. The difference comes from non-cash amortization of intangible assets. So it's more of a reporting artifact, not a solvency warning. But while a value of 8 times is much better than the 2.7 times, it is still far from excellent. And the valuation problem it creates is real. There are 2 risks worth naming before we get to the valuation though. Neither of them is existential, but both matter. The first is China. Before the export controls in 2025, China represented around 16% of Synopsys revenue. In the last 3 months, this was only 10.5%. That's roughly 5% of the annual revenue that got cut off by a policy decision. Synopsys didn't lose those customers. The US government removed them. The second risk is AI, and this one is two-sided, because Synopsys has been leaning into it. Their Synopsys.ai suite uses AI to speed up parts of the design flow, and they are pricing it on value, which expands revenue per seat. That's the bull case. The bear case is that if AI gets good enough to automate significant parts of the chip design, the number of engineering seats could shrink, and less seats means less revenue. That's not happening yet, but it's a real structural question, especially if you're a long-term investor. Neither of these risks kills the investment thesis, but they do limit the bull run, and that matters when we look at the price. So everything I've shown you so far looks pretty good. The moat is wide, the business quality is great, the compounding track record is real. But none of that tells you whether the stock is worth buying at today's price. For that, let's look at my discounted cash flow analysis. As inputs, I use the numbers from the trailing 12 months, namely an unlevered free cash flow of 3.35 billion, a WACC of 8.2%, a terminal growth rate of 3%, and a short-term growth rate of 14%. With these assumptions, I come to a fair value of $463. At today's price, that is about 4% upside. Not too much, but the stock also doesn't seem to be overvalued. Now, the 3.35 billion cash flow is the trailing 12-month unlevered free cash flow. But the trailing 12 months also include a seasonally strong collection period in the first half and some early effects from the Ansys acquisition. If we apply a roughly 10% cut to normalize that to, let's say, 3 billion, the fair value drops to $410. That is 8% below where the stock trades today. And the sensitivity matrix tells the same story. There is virtually no margin of safety at today's price, and the numbers are tight at best even when we include the organic one-time effects from the acquisition. Wall Street is a bit more bullish for the stock. The 21 analysts that cover the company see a 28% average upside for the company, with the lowest estimation being roughly at the price today. The current valuation, here on a forward-looking basis, is also around 20% below the averages of their last 5 years. So, compared to their own valuation, the current price does look attractive. So where does this all leave us? Synopsys is one of the highest quality businesses with one of the widest moats that I ever analyzed on this channel. The financial track record before the Ansys deal was exceptional. And the Ansys acquisition, while expensive and messy on the balance sheet, does extend the competitive position even further. But the stock at $446 gives you almost no margin of safety. My base case discounted cash flow analysis puts the fair value at $463. Apply a 10% margin of safety and the entry price is around $417. So despite the great business, I would still wait a bit before investing and instead put them on my watch list. The level I am watching is somewhere in the 420 and 380 range. And there are two more reasons why this goes on my watch list. First, Elliott Management took an activist stake in the company in March, and Nvidia made a $2 billion strategic investment in the company. Custom silicon like ASICs and TPUs from hyperscalers like Google and Amazon are also multiplying design starts and also have a high design complexity. This drives the design costs higher, while at the same time there is a shortage of skilled workers in this industry. These are all tailwinds for the company, and the greater electronics design automation market is expected to grow with around 10% annually until 2032. So I'll definitely keep watching this stock and wait for it to pull back just a little bit more. But as always, that's just my opinion. Now, I would like to hear from you. Did you already know Synopsys before watching this video? And which company should I do next for my White Moat series? Let me know down in the comments. And if you would like to know why Netflix stock crashed and what my exact buy price for them is, watch this video next. And as always, this is no financial advice, so please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching guys, and see you in the next video.